The markets finished the week on a high note, higher than probably we expected for this week, going into this week. So we'll see now, how does that impact the expectations going into next week, especially with options expiration today and another basket of earnings coming out on the docket next week. So we're going to break all that down, take a look at our outlook and how it's changed, if at all, in the short term as well as in the intermediate term and going into the end of the year. And we take a look at a stock that's been really beaten up last year in a sector that has potential to outperform in the coming year for various macro reasons, and in a stock that may be giving us a good signal now to start a new trend trade on it. So let's go ahead and get started. Today is Friday, January the 18th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. Alright, as always, let's start off taking a look at the S&P 500 with the market forecast indicator, which continued higher today. So 4 consecutive days to the upside, another strong week, 4 consecutive strong weeks coming off that Christmas Eve low point. We haven't had this type of move over 4 consecutive weeks since March, April of 2009, which was the last time that we had consecutive daily oversold clusters like this on the market forecast. So not that we are ending a bear market like we were then, a long extended bear market where we fell off a cliff, but the type of move that we had in March where you were bearish heading into it, and then you just had this kind of consolidative sell-off over a really short amount of time that was deep and it was consecutive and it was kind of blow off to the downside, and then followed by a big move to the upside. That's what we're seeing right now. Now you notice here, if you take a look at the moving average, it's still yellow, and it still will be yellow on Monday because it dropped lower today. We are above it, that's why it's yellow and not red. If it's falling and you're below it, it turns red. So we still don't have what we need. In fact, what happened in 2009, if I were to go back, we'll take a look at it here in a second. But if I go back to 2009, we hit the 200-day moving average. We kind of jumped up through the 50 and hit the 200 before pulling back. And that's about what we're doing right now with today's move, last couple of days move. This really kind of jumping up sharply on a positive. This like negative headlines produced all of this. Positive headlines is producing all of this. Now, you also have, a lot of this was catch up to the global slowdown, the global drop in bear market that you actually had in foreign stocks, right? Germany and UK and China had all been in extended declines for most of the year. So a lot of this was catch up, number one. Number two, economic indicators are slower, not to the extent that we're looking at a recession, which a lot of people suggested this might be telling us. And that's why we've recovered so quickly off of that, because that's not the case. And we are back up into this area where we were touching lows and looking for a bounce before that last kind of post-FOMC blow-off, or like pre and post-FOMC blow-off type move. So you can see now this run that we've had, and really the near-term line here, if I were to, this current near-term run started at that low point right there and continues higher, right? Instead of peaking kind of where we were expecting last Friday at this level and then rolling over to about 2,500. See, if that would have been the case, if we would have peaked there and rolled over to 2,500, that would have been, 62% retracement of that Fibonacci retracement level. Right, but now that we have moved higher, when you get higher, when you get bigger near-term moves, when you have a bigger inhale, then the exhale gets bigger as well. And so, to get back to 2,500 now will get you through the Fibonacci retracement zone. And so now, that would appear deeper, but again, the only reason why it is deeper is because instead of, we take a breath in and we start to take a breath out, but right before we fully exhale, right, which would have been very normal Fibonacci retracement, we take another breath in. And so that's, again, when you take a nice deep inhale, you start to exhale, but before you finish, you start another deep inhale. well, eventually you've got to exhale, and so you'll have deeper pullbacks as a result, and they won't mean anything in terms of like, oh no, we're, you know, this is all fake, you know, bear trap rally. No, it's just going to mean that we went up so much, and now we got to come back. I mean, remember, this pullback here is just a 50% retracement off the 2016 lows, the last time we were in a global pullback, economic slowdown environment. So early 2016, late 2015, where it finally caught up to the U.S. at those time frames, but had been slow for pretty much all of 2015. Very similar to what we saw in 2017, where the U.S. markets were able to hold up and stay relatively flat while the global markets were falling, and then finally at the end of 15, the U.S. markets kind of catching up. So that's what we saw here. The posture is bullish. Near-term sentiment is very bullish, and it's mature. You know, we've got what, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days. The typical range is 7 to 12 days, and that's when the near-term run starts, when you're already got a bullish posture. So, you know, 3 to 5 is normal when you're coming up off of a weak bullish posture, when you're starting a near-term run in a weak bullish posture. So we are kind of double the longest time frame. So this would have been typical here, but instead of breathing out, we continue to breathe in. And so keep that in mind, that especially with expiration, with options expiration here this Friday, you've got, you know, you've had typical weakness, at best flat, if not weak, coming out of options expiration. And of course the famous Christmas Eve coming out of the December options expiration. So we'll see if that plays out and at least starts a little bit of weakness here heading into next week. Market sentiment's rising. In fact, for the Russell 2000, market sentiment's finally crossed above 20. So now you have the same pattern on all these major indexes: a bullish intermediate posture, but you don't have the green line yet on the moving average. So we're not expecting 1 to 3 months yet. The near-term line is bullish, and for a lot of these has been more bullish. Like we haven't had that pullback. You can see how it would have been very normal for us to get a little bit of a pullback here, but instead we rally. And the other thing to keep in mind too, you know, when you go back to the S&P 500, you know, when we got up to 2,600 here last week, everybody saw the same level. A lot of people were talking about, you know, we're going to hit some resistance, we're going to pull back in the short term, retest these lows. I mean that's what we talked about. I mean, and I was hardly unique in that outlook. So when a lot of people start looking for the same thing, then you'll get this kind of move, which will try to nullify that and try to capture in people thinking, well, we're not going to get that, and now we're bullish. Right? Well, the reality is, no, a lot of times that can be what's called a fake out, where you break through a resistance that everybody sees in the short term, and then we pop right back down. And especially with options expiration today, I wouldn't be surprised if next week this turns more into a fake out, and we finally do get that pullback down to this 2,500-ish level that we were expecting last week, after a week here of positive headlines producing a not a sustainable move in the short term, right? An inhale that was coming off of a very, very shallow exhale, too shallow to keep a regular breathing pattern, if you were to continue the analogy out. Alright, before we look at some other charts, subscribe to our YouTube channel. Mouse over the Market Scholars logo right here in the bottom right corner of the video, then hit this red subscribe button that pops out. Also, click this thumbs up icon right below the video. That tells us that you want us to do the video again on Monday. One-click way to give us feedback. Again, remember, the worst thing you can do if you don't like the video is not to click on anything, because YouTube promotes videos that have engagement, whether it's thumbs up or thumbs down. So we like that. We like to have the engagement there. Also, they promote videos with comments. So comment on anything that stands out to you that you got out of tonight's video. Also, if you're watching the video on our blog, you can do the same thing and like the Market Outlook tweet here by clicking on this heart. That opens up a new window where you can like the tweet here Also, click this image, takes you to your Facebook page where you can like tonight's Market Outlook post, and also click this icon. So again, those clicks tell us that you like the video today, that you want us to keep doing these videos. It also tells those social networks that you want them to keep promoting our stuff to you, right? Because they don't always show you everything, but the more you engage with our content, the more they'll keep showing you all of our content on both those networks. Also, quick reminder, no classes on our site here on Monday. It's a holiday on Monday. Markets also closed on Monday. We're back to our normal schedule on Tuesday with Brandon's very popular dividend growth investing class. And then, of course, my class later that on Tuesday, the directional option strategies class. All right, look at that weekly chart here, and you can see this big jump up. We broke through the 50-day moving average this week and have really came close to the 200-day moving average. Remember, we are using a 10-week and a 40-week exponential moving average as our proxies for the 50 and 200. So really close there, right at 26.95, so we're at 26.70. This is kind of give you an idea of what we look like in 2009. So let me do a little custom chart here. We'll go to like March 1st of 2009, and then so we'll go March the 2nd of 5 years previous, and we'll take a look at a weekly chart. So this is here we are, and let's get rid of some of these Fibonacci. Well, I can zoom in, you can see it. So there's the move that we had in 2009. There's those 4 consecutive strong weeks that we had. Remember, this isn't a logarithmic scale. Here, let me change it. Whoops, not there. Here, so you can see a logarithmic scale and see how big these moves were. Right, these were really big moves when you look at it on the log scale. So these were 4 consecutive, these actually I think right here were the 4 consecutive 1-week moves where we blasted through the 50-day moving average, actually got to the 200-day moving average. So I actually need to go past June. I need to go to like November, and then so over here we'll go to November too. Alright, so you can see that's when we hit the 200-day moving average and we went sideways for a while and had a little bit of a pullback off of it. And then we started the run, right? Then we got the golden cross and we started our rally in 2009. That's when this whole thing started. So, you know, remember, that's this little blow-off kind of blow-off consolidation move over a 4-week period. Very similar to what you're getting over here in this kind of 2-week period, one big 1-week period, really. And now we're, boom, right back up. So we were okay. Things were looking okay right there until that 1 week. And you can see it took 3 weeks, but we recovered that, and now more than recovered that as we've gotten back up above these lows and towards the 200. You still would expect a test of that 200-day moving average. You know, that second low point. They usually get off the 50, but we were so far below the 50 that the move to get to the 50 was so strong. You got a lot of positive momentum getting you through it. Still look for that to hold that, you know, one of these, in this case now the 200, and then get that second low point, which the odds of that second low point even approaching 2400 are getting lower and lower because of how far up we're going. So again, probably more likely down to that 2500 into this Fibonacci retracement zone. And remember that 2009 low point only got to 23% Fibonacci retracement. So and then we'll get that bounce, and then we'll get the golden cross that we are expecting. And if we don't, if we get to the 200 and fail and we do start heading down, then we know we're not going to get the type of bullish year that we're expecting. From a 3 green arrow standpoint, again, you have 3 green arrows, but you don't have the rising moving average yet. So we'll take a look at that here next week and see if that happens. And remember, the 2 lines, we are still above that 8-day moving average, sharply above the 8-day moving average. In fact, the 8-day is sharply above the 17-day. Let me give you some context on just how bullish that is. You know, it's the bullish momentum right now. There's only been one other time that it was stronger over the last 2 years on an absolute basis. And you remember, 27 points at 26.70, so that's over 1%. That's much bigger than 37 points. Well, it's a little bit not let's see, right here we were at 27 points right in this area, so right about there. Yeah, right there. We were at 27 points there, and the S&P at that time was 2776, so we were just at 1%. And now we're over 1% with where we're at now, just over 1%. So, you know, this is a very similar move, bullish-wise, that we got last January. Last January, we were at the end of an already extended intermediate run that we went for another month. And there's your blow-off top to the, you know, this consolidation move like this, but to the top side. And you can see what happened there. And so again, the expectation, if we get a pullback, you know, it's anywhere close to something like this, it won't be because we're not bullish or we're not so bullish or the market is in a bear market. It's going to be because we were that bullish, right? We were so bullish that the momentum got extremely strong, which is rare for it to get this strong coming off of such an extreme low without, you know, hiccuping first here. So the more you inhale without that normal exhale, then the deeper the eventual exhale will be, right? Eventually, and it won't be an exhale like, you know, again, it won't be an exhale that will say, you know, oh no, this is it, the world's going to end. It's going to be just a typical Fibonacci retracement that will be bigger because the move preceding the retracement is bigger. It's simply because of that. Now, when you look at the intraday moves, you can see another 4-week high point. So that tag continues. Now we are, you know, you've got what between 266, 232. You still have about a 33 point move, which is well over 1% or 10%. So you still have a very extreme range, which means you can still, I mean, we can still have a Fibonacci retracement pullback into this area and still be in the 4-week range, right? So again, another reason why, you know, don't take any kind of pullback we may get next week that may be bigger than these kind of these moves that we're getting to the upside right now. Don't put more stock into them than that, because again, the move up has kept the range very strong, very high, which means the moves within the range can also be very big too and not break significant support levels in the process. Now this will start to move up. We've still got a couple of days before it moves up, but then on one day it'll move up to there, and then on the next day it'll move up to there, and then you'll have about a week or a few days of it sitting at 243. So that's 11 points higher, a little bit more than 11 points higher, which means that this will move about 5.5 points higher. So it'll move up to about this 250. It'll move up into this area right here for that 4-week range. So again, we can fall to this 250 to 255 area within the next week and still stay in the top half of what would be still the top half of the 4-week range over the next little bit. And that would actually be over the next couple of weeks, because again, over the next week you're going to be just moving up about 6 points over the next week by the end of the week, which means that this will move up to about 253 right into this area where this Fibonacci, where this week's Hakunashi Open was. So like I said, you can pull back, you know, 15 points on SPY by the end of next week and still be in the upper half of the 4-week range, which would mean on the short term that we're still bullish despite the pullback. Alright, let's take a look at the volume and the range today, which are actually relatively large considering. You can see the range was 3.9, a little bit below the average, higher than what we've seen this week. You know, we had a decent range yesterday, but last time I did the video on Wednesday, very, very small range, very low volume. The volume picked up today, 128 million. So 128 million puts us right just a little bit below the average, but relatively high within the 52-week range. The 3-point range, a little bit below the average, but still in the middle of so it's not really, really low like this. That's why they're kind of flattening out. And it was also more than 1%. So, you know, below 1% that's when you got the bullish trend established, is when you're getting consistent days with smaller than 1% range. Remember, as a index gets higher, the move to 1% move gets higher too, right? It's 26 points right now. It'd be 30 points up here. So it kind of gives you an idea that the moves can get bigger and we can still stay within 1% of the average range. So decent move today, decent move this week, and volatility, if you notice, volatility is dropping, but still just inside this upper end of the neutral range. The top end of the neutral range between 90 and 95% can act as a support, but so can the bottom end. So it's not till you break that bottom end and you get into this bullish zone that the bullish trend has started. Anytime you're in this neutral range or above it especially, you can still get some volatility. The market's still figuring out that low point. So that's why, we're not back up the truck bull. We're not, expectations of 1 to 3 month bullish run yet until we break through this 90% level. Remember last year when the bullish trend finally started in May, right? When you finally got the dark green shading in the market forecast with the intermediate line crossing above 50, and the green line on the moving average, which means we were above a rising moving average. That didn't occur until May, that May 4th area, and that's when the volatility index finally broke below the 90% level, right? All the way until then, while we were still trying to figure out that low point, volatility stayed, used the 95% as support, used the 90% as support, and then finally broke through 90% when you got that bullish cross finally on the market forecast in early May. And that started, the first intermediate run that lasted about a month plus, and then the second intermediate run that started there before we got the weakness at the end of the year. All right, before we take a look at what's driving the action today and take a look at a trade idea for today, let's summarize our technical outlook here. The markets continue to be bullish. We were expecting a short-term pullback this week, which would have been normal and healthy. We got headlines that drove us up even more this week through what was a widely viewed resistance level at 2,600 at the 50-day moving average. We broke right on through that and are now a lot closer to the 200-day moving average. We've seen that pattern before. This type of 4-week rally we've seen before, coming up off of a big consolidative low point with multiple clusters before. This was all early 2009, spring of 2009. So we're seeing a similar pattern play out here. And again, that usually we find some weakness. If we don't get the weakness at the 50, we usually find it at the 200. So we'll see if that ends up being the case. Now, again, you got to get a near-term pullback at some point. The markets always do. And now that that near-term run has been twice as long as normal, just expect the near-term pullback to be bigger than normal too. Not bigger that you'd expect us now, oh no, we're not bullish anymore, we're bearish, but only deeper because of the rally before that was a 50% retracement of a bigger move is bigger than a 50% retracement of a smaller move. And now, because of this week's extra rally we got, again, expect to pull back as soon as next week to be bigger as a result. So, but that won't change the sentiment, right? We still expect eventually to get that golden cross on the S&P and to start new intermediate rallies. We just don't expect that yet because we don't have the technical setups yet that would say, here we go, right? So what do you think? Do you agree or disagree with that? Click that link popping out in the top right corner of your screen. Then click either agree or disagree in the poll that pops down. If you click disagree, scroll down below and comment on the YouTube video on what you see. Share with us what you're seeing that would suggest otherwise. So also a reminder, follow me on Twitter for more content like this throughout the day. And also you can join our Market Outlook community that we created on Facebook with other market scholars and other people who watch these videos day after day. Also join our daily Market Outlook email list. There's a link, email going out this weekend. For the first time, we have overbought clusters on the market forecast with stocks in the S&P 500. We don't get that very often. There's a link popping out in the top right corner up there. You can click that link to subscribe to that list to get that email with those watch lists. Okay, on a week where the stocks rose almost 3%, you can see the nice little rally we had today. So the S&P up almost 3%, small caps up only 2.5% for the week. Excuse me, you can see crude oil really gaining gaining a lot today. Remember how it fell so much during the pullback over the last quarter? You can see that during this recent run, it's been doing very, very well. Up 4%. International stocks declining, so lagging behind U.S. stocks this week. Emerging markets outpacing developed markets. So Brexit still kind of weighing on that developed space. Not surprising to see safe haven areas like gold and long-term bonds down for the week. The dollar is actually really strong for the week. It's kind of rare to see stocks so bullish with the dollar as bullish as it was too. So the dollar, which had been pulling back over a little bit, had a very strong week this week, and that put pressure on gold, which actually has been rising lately, but did not put pressure obviously on crude oil, which had a it's a higher beta asset class anyway, but it had a really strong week on this week of pretty decent risk appetite. Now, when you take a look at our calendar, industrial production was out here. If you take a look at the industrial production numbers, which is red here, it just kind of gives you an idea of economic growth potential, right? So you can see that it's down. It's not as high as it was last year, but still very, very strong number at 4% and falling down on a year-over-year basis. The month-over-month numbers down in the production area, and that's why the year-over-year figure is declining a little bit. Consumer sentiment, which is the initial preliminary reading in the University of Michigan sentiment survey, you can see down sharply lower from where we were all of last year. So a little bit of a weak reading there. When you take a look at the economic surprise index, you can see that it's still flat. It's a little bit negative, but over in Europe or in Asia, the G10 economic indicators are pretty negative, or sharply negative, as negative as they've been. So again, another sign. Remember, in late 2015 or all of 2015 and early 16, we were in a global recession outside of the U.S. The U.S. didn't. Also in 2011. So you can kind of see that, compared to 15 and 16, we're at very similar negative levels, which is another sign why people are saying that we are in a global recession right now. Again, outside of the S&P, the U.S. markets, which clearly we're not yet. If you take a look at what's going to happen here on the economic calendar next week, remember the holiday on Monday. We have existing home sales on Tuesday. Very, very minor indicators on housing and the manufacturing on Wednesday. Then you have your jobless claims on Thursday with the petroleum report as well. Another minor manufacturing indicator. Leading indicators coming out. And then we end Friday with a couple big ones, new home sales and durable goods. So a relatively light week on the economic calendar. It picks up at the end of the week. Earnings, you can see not a whole lot on Monday. Again, the hot market holiday on Monday. Tuesday we pick up a little bit. You got Johnson & Johnson, IBM, UBS, Capital and a couple of financials, TD Ameritrade, Halliburton, and the energy space. So you can see kind of what stocks are coming out Tuesday. Wednesday, we have another big basket of earnings announcement. Procter & Gamble, Abbott, Comcast, United Technologies. So you kind of get an idea of the different spaces. We don't have the big tech names yet, right? We've had the big financials. The big tech names will be coming out later. Here's Intel, Bristol Myers. So some consumer staples, especially in the health space. Some industrial names still. Starbucks will be coming out. But not the big names quite yet, right? It'll be the week after. So next week might be a little bit of a pause in terms of the big names, and that might be, again, another reason to get that pullback before we start getting the bigger names coming out, especially in that technology, consumer discretionary, new communication services space the following week. You can see, interestingly enough, the bullish week that we've had actually raised odds for a rate hike up to 1 in 3. That will get at least one rate hike in 2019. Now remember, the Fed at the last projections in December were looking for 2 rate hikes in 2019, and then we had the sell-off afterwards, and that pretty much took all those odds off the table and actually increased the odds for a rate for a rate cut. But now if you take a look at what's going on here with the rate hike odds. So here is the current levels, and you can see the current levels took off. This is for December of 19 now. This is by the end of this year. This is the purple line is where we're at currently, and that took off. It was really, really low in the early November. There's a few of these others. You know, there's one rate hike there. This would be 2 rate hikes. This would be, excuse me, the red line would be 1 rate hike. This gray line would be 2 rate hikes. And then this dark blue line would be 3 rate hikes. So the odds for those things were all higher than no rate hike at all in early November. And then things changed, right? The 3 rate hikes fell off the table, and then the 2 rate hikes in gray fell off the table, and then the 1 rate hike in December also fell off the table. All of them dropping to 0. The one has since bounced up, and the rate cut, which is this green line, which had really rallied and peaked earlier this month, has fallen off down to close to nothing. So if we do get any move, as of right now, the market's saying if we do get any move, it will be a rate hike sometime this year. But even that, again, those odds around 30 some odd percent, 1 in 3 chance are still very low. Still more likely 2 out of 3 that we won't get any move at all, that the Fed's done with their rate hike cycle. Really quickly here, you can see how the week performed in terms of the sector rotation. Utility starting the week off weak, finished the week with the only loss among all the sectors, whereas financials had the best week. They had their earnings this week. All the big names had their earnings come out. They had their big bounce back rally here, up 6%. Industrials also had a pretty decent week. There's also some industrial names with earnings out this week, up 3%. Everything else lagging, right? Everything else up, but lagging the broad market. So it's really, this week is really all about the financials. That's what pushed the markets as high as they did. Financials, and to a lesser degree, industrials. Everything else kind of following along and lagging just a little bit. Remember, not a lot of big names yet in these spaces with their earnings. Next week you'll have some more staples coming out and some healthcare as well. And then the week after you'll start to get the more cyclical names, some of the bigger cyclical names, and we'll see if that continues. So we'll see if the dearth of those big names next week is what produces the pullback before we either rally or don't after that. Again, the expectations are that we will, but of course you have to keep your eyes open for any possible outcome, despite what your expectations may be. One stock that was really beaten up over the past year, along with all these, very similar move to the international weakness we saw for most of the year, was in this energy sector. Schlumberger coming out with earnings here, and a nice good rally coming out of that. And you notice it's got a 3 green arrow signal that now will have a rising moving average, because you can see it's yellow, but on Monday, because it rallied, the moving average went up today. The green line, the moving average will turn green on Tuesday. So you have 3 green arrows with a spike in volume on the earnings, on this kind of a sideways trend, but we'll have green shading here because of the 3 green arrows and a rising moving average, right? And you'll also notice here on the market forecast, because it will turn green, the moving average will turn green on Tuesday there too, right? Because again, it just went up a little bit. All it takes is a little bit for it to go up. But you also have the dark green shading here with a green what will be a green moving average on Tuesday. So you have the beginnings of a new trend starting in this company. If you take a look at the stock and the Bollinger Bands, you can see that we had some volume picking up in this area. Not a lot of volume because we fell so fast during this Q4 from 60 all the way to 30 practically. Well, 65 to 35. We fell so fast, there's not a lot of resistance in the area because there's not very much volume. So we have the opportunity now to trend higher until we get up to around 60, 61, where the next kind of volume node is that can act as a resistance now that we've broken through this volume node. So, good potential here for a trend trade on a stock in a really beaten up energy in the energy space. That we would expect would be if the markets are bullish this year and commodities do rally and the dollar remains soft, we would expect a stock like this to recover. I mean, it's down more than 50% in the last year. Even if it just did a 50% retracement, getting up to the 60 area would just simply be a retracement move. But we could get some pretty decent gains on a stock like this on that type of a move. Alright, that wraps us up for today. Again, thank you very much for watching. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen there to comment in our Market Outlook forums on marketscholars.com. Remember, you have to subscribe on the site to be able to participate in those forums, but you can do that for free. Also, remember to subscribe to our channel, click the thumbs up icon, let us know that you want us to keep doing these videos, and then comment on anything that stood out to you. Any questions or comments you have for me as well, comment down below. Remember to follow me on Twitter, join our community on Facebook, join our daily Market Outlook email list as well. Thanks again, have a great rest of your weekend, and we'll see you all on Tuesday.